Hi guys, and welcome to Freckle Finance. Today I'm going to talk to you about bonds. A bond is a debt investment where an investor loans money to a company or a government for a defined period of time. This borrowed amount would be either paid in a fixed or a variable rate. So this is similar to if you are taking out a loan from a bank, you are the company and the bank is the investor, and that's very similar to how a bond is paid out. Some bonds are traded on the market, some of them are traded over the counter. You can also buy bonds that are mutual funds, and you can also buy bonds in the form of ETFs as well. So there's many different ways that you can buy bonds, but you can also just buy the straight bonds as well. A bond is similar to a stock in the sense that the company or government needs money and they have to obtain it some way, and they can either sell a portion of their company as a stock, which this is not something the government does, so they don't do stocks, or they loan some money from somebody else, and instead of using a financial institution, they use consumers. The two main features of a bond is the credit score of the company and the duration of the bond itself. So if a company has poor credit and it's known for not paying their bills on time or not paying them at all, then they are at a much higher risk for default, and that will make the value of the bond lower. As well, if they have really good history of payment and such, they will have higher values for their bonds because people know that if they put more money into a bond to get a better value bond, they are more likely to get money back, and there's less likelihood for default on that bond. The duration of a bond can be anywhere from 3 days to 30 years, and really the longer term of the bond, the higher the interest rate is for that bond, because if the bond is longer, there's more likelihood of something happening. Like in 30 years, a startup company that's very small could go bankrupt. There's just a lot higher risk associated with a longer term of a bond being paid for by a company, and so the interest rates are higher. So how does a bond work? The indebted, such as a company or government or any other entity that is selling a bond, will issue a bond, and within that bond it will state how, when the money needs to be paid back, how much the interest rate is going to be, whether it's fixed or variable, and when the initial loan plus the interest will be paid back. So as I mentioned earlier, bonds can be purchased as an ETF or mutual fund as well, which would allow you to have a diversified bond portfolio within your bond, so that way you're not risking all of your money that you're allocating towards bond to one specific company, and that will make it less risky as well. As well, the older you are or the closer that you are to retirement should indicate how much bonds that you have, or a percentage of your portfolio that should be bonds. The older you get, the higher it should get, because bonds are actually considered a relatively safe investment. It's just you don't want to have a lot of them when you're younger because they don't make that much money. Like stocks make a lot more money for you than a bond would, but you do need the security of the safety that generally bonds give you over stocks as you get older, so you will want to have more of them in your portfolio. So bonds are considered relatively safe because the chances of you losing out on your initial principal are actually really quite small. And specifically, many government bonds will actually guarantee the initial investment so that you will not actually lose that investment. However, generally the interest rates that you make on those are quite small. If anyone's ever had a government bond, I know I had some when I was younger. I don't remember the interest rates, but I remember it was probably really quite small, maybe somewhere around what a GIC will get you. It depends on specifically what government loan at what level you're getting, but generally, yes, if something is guaranteeing your initial investment, the interest rate that they will guarantee you is generally smaller. Another thing that makes bonds attractive to many people is that they provide interest payments on a regular basis. Some of them will be monthly, not all of them necessarily pay on the same schedule, but they will be fairly regular payments out, and that's sort of like, I guess, dividends for the stock market, except these are guaranteed payments that you're going to get, or mostly guaranteed payments, because as I said, the risk is small. And this allows people to be able to generate some income on their investments that they're making, that they don't have to sell a bond in order to get. The regular interest payments that you receive from bonds are considered safer than dividends because a company actually is obligated contractually to pay out the interest owing on bonds before they are to pay out on dividends. And that's because you have a contract stating that's the money you get, and dividends are just paid out from profits, and that will be taken out of the profits before they can pay out a dividend. Not all bonds are considered as safe as other. They're not all on an equal playing field, and not all of them should be in your portfolio. There is actually a bond rating system that will help you out when it comes to which bonds you should buy. One type of bond, and there are others that are not considered good to purchase, is emerging market bonds. And that's because these are coming from companies who are in an industry that is not established yet. It's a new industry, just like when tech came, there was a bunch of tech companies and there was a tech bubble which burst. So that at the time would have been an emerging market, and that's higher risk for those companies to default, and they won't be able to pay the bond back. As well, even though you generally make more money off stocks than you would on bonds, bonds are less risky. When the market is doing poorly, bonds still generally hold up pretty well. Not guaranteed, as I said, but usually does pretty well. And that's one of the reasons why you want to have bonds in your portfolio, so that when all your stocks are at a loss or whatever, you still have some stuff making money, so that your entire portfolio is not ruined. You're not going to lose all of your money. That's part of the point of diversification. As well, when it comes time for you to purchase bonds, it's important to note that there are no fees or commissions, MER fees, anything like that on the bond itself. However, they will increase the price of the bond that they are selling at from the price that they pay for it. I mean, this is their job. They do need to make money, but that is important to note, that there is no fee. You don't have to pay a fee like you would with a stock, but they will increase the price because they do need to make money. I currently don't have any bonds in my portfolio, but as I said, it's important to have as you get older, especially closer to retirement. Right now, I feel I'm young and I have the opportunity to take on the higher risk that not having bonds allows me, which will make me more money, but in the future, I will be adding bonds to my portfolio. As well, if you're into lower risk investments than say I or the general public is into, what you need to do is you need to look up online risk assessment tests, do several of them, and think about it. Think, how much risk are you really willing to take? If you want less risk, you should have more bonds, but you should still always have stocks because those are the real money makers. But the less risk you are comfortable with, the more bonds you should really have in your portfolio. If you find these videos interesting and informative and you want to learn more, please click subscribe, as I will be uploading videos every Monday, Wednesday, and Friday. Have a good day. Bye.